Welcome back to the Scholar Advising Podcast. In today's episode, we're digging into a few complex choices that can have a lasting impact on your wealth and lifestyle. First, we'll tackle a question from a listener with $20 million tied up in private company stock who's preparing for a major liquidity event. Next, we'll shift to a lifestyle decision, whether joining an exclusive social club with significant initiation fees and annual dues can fit into the broader financial plan. And our third question comes from a couple in their 40s who's reached coast financial independence and are considering shifting to part-time work to spend more time traveling with their kids. To wrap up, this week's rotating segment is Money in the Headlines. We'll take a look at a recent Wall Street Journal article on why so many people get financial advice that doesn't actually fit them. So let's get started with question one.
We have about $20 million in private company stock that we expect to sell in the next 3 years. Our estate plan already includes several trusts, but we're worried about having so much of our wealth tied up in one asset class before the sale. What strategies do you recommend for balancing diversification with preserving the legacy of our business for future generations?
So there are a lot of options to jump into here with the potential sale of a company. The first is we have to really fall into what this value is. It's really easy to start tossing around values and what you think it could sell for, but you're in this window. If you're looking at 3 years for a sale, well, that may seem like a long time. It seems like a long time from the risk that you're considering taking on here. The issue we have is that this process to get rid of something worth $20 million is not going to be something where you snap your fingers and you have a check for $20 million hits your account and then you have to worry about taxes. Everyone seems to jump to the tax concern saying, well, I know I'm going to sell my business. What can I do for taxes? Really, you have to worry about selling the business first. So how do we get to that point within those 3 years? 3 years, still a long way away, right? We need to start worrying about how to structure the sale. And a lot of times, if you're a large part of this business, which sounds like it is, you're not going to be able to go and no one's going to write you a check for $20 million. You walk away the next day and you're retired. What's going to end up happening is they're going to keep you there for a couple of years. It's going to be some sort of earn out or buyout associated with it, which is to hedge their risk as well. They don't want to hand you $20 million. They want to hand you a few $1,000,000 with the rest of the money contingent on business performance for the next few years. So because of that, if your goal is to get out of this in 3 years and you're already worried about the risk of concentration right now, then we should be looking now at ways for you to start diversifying out of this. Not only from a cash flow perspective, but also just diversifying out of the holding in general. In other words, can you start talking to bankers now? Do you start bringing on and interviewing lawyers? Do you start going into looking at who would be strategic buyers? You're always going to get a higher multiple through strategic buyers in an acquisition. They have more to gain. You have the whole synergy idea of them adding you their business models could be better. So we start there, and then 3 years is a perfect window to where you can start that process, maybe start getting some bids, get a better idea of what this valuation looks like, and then start looking at that divestiture. Now, that's a little farther away from the question, which is huge concentration. What do we do? I think the easiest way to get rid of the concentration is to get rid of the business. That's sometimes easier said than done, as we were just saying, but it doesn't mean you can't start some of that now, whether it's a partial sale, whether it's allowing some internal purchasing to happen, depending on the type of business that you're into. You can also go in, if you need liquidity, if liquidity is the issue, you can start taking out loans against equity. That's going to be a lot harder to do with this type of structure. And assuming the 20 million is the lion's share of the equity in the holdings. When it comes to trusts and how you're going to handle that portion of it, you can start moving some of that ownership into trusts now, depending on what you think valuations are now versus what you think valuations will be in the future. If you looked at it and said, Stephan, I think this business is going to skyrocket over the next few years and these shares are going to go from 20 million to 60 million, then that may be a good opportunity for you to talk to an attorney about, can we move some of that ownership into a trust to lock in the current valuations? So that way, when the business increases in value, all of that increase in value is now in the trust and not as part of your estate, especially since you're dancing around a really critical number there at $20 million, where you're getting close to that estate limit, which is going to start to require some additional thinking about how you're using trust, what assets should be moved into a trust, and future growth rate there. Once all that happens, then you start looking at post liquidity. So once you have an idea of what you think the valuation is today, what you think the valuation could be in the future, what path you have to start divesting. Then once you have the money out of that, or at least have a plan for it, then you can start talking about post liquidity event diversification. That goes back to the basics. You're going to end up with a bunch of cash. So what are the holdings you should buy? What's the asset allocation look like? Based on the holdings now in private stock, likely be mostly in public stock holdings. So you're going to be in the public financial markets. You may want to keep some for private investment, depending on what your goals are afterwards. But it really takes you back in a relatively easy position to be in. Of we have a lot of cash to be able to look at all of this now, as opposed to we have to diversify away from a concentrated position. So that's going to be the real meat of it there. That's also where you start dealing with legacy goals and charitable giving, because what you're going to want to do is back out of that, say, all right, out of this $20 million sale, maybe we actually realized 17, 18, and for ease of numbers, you've got $10 million that is actually sitting in your bank account. So that year you need to determine how much do you actually need to live on. Is 10 million enough? Is 10 million more than you need? Because if it ends up being more than you need, then that's times where you can start thinking about charitable giving, foundations, and starting to preserve some interest in the company, or especially if you have family goals there as well. You may want to hold a portion of the company. You may be forced to hold a portion of the company. It's really common in type of private deals where you'll receive some cash, but then some of the ownership is actually going to be in a private equity fund that bought you out. So lots of different options there and a lot of different structures. I think the one thing to keep in mind when you go through this whole process with your business is that there's not a one size fits all scenario that you're going to go down. Once you start writing up those contracts and thinking about what an exit looks like in a liquidity event, you can structure it however you want. And that's the beauty of these, and why a lot of people find these exciting areas of finance, is because you can get really creative with the ways to finance a deal, to have liquidity from a deal, or to have an earnout. So great question. Definitely something to start thinking about now, as opposed to waiting for 3 years. And now we can jump into question number 2.
We were recently invited to apply for a private social club here in New York, and we, especially my wife, are excited but trying to be thoughtful before saying yes. The initiation fee is $50K, and the annual dues are $10K for an individual or $18K for a couple. The club promises strong networking and cultural opportunities, but I'm not as convinced as my better half is that we should make this big of a commitment. How do you help families decide if something like this fits into their broader financial plan?
So in situations like this, before we get into anything else, the first thing is, can you afford it? Right? It's a mere point if you can't afford the $50,000 initiation or the ongoing costs. So that has to be first. You have to take a look at the overall plan. Do you have the discretionary cash flow to put the 50,000 in and pay the 10, 18 that you're going to be dealing with on an ongoing basis? If the answer is yes, then we can continue the conversation. If not, then it's done. You're not going to be able to go even had the conversation. So assuming you can and everything looks good on the plan, you're able to hit the savings goals, you're able to hit your spending goals that you have, everything looks good, and you have some discretionary cash left over, then we get into this area of, well, should we? Usually the pitch of many of these clubs is that the networking opportunities are great. Some of them have access to private investments. You're going to talk about private investments. So you have all of these other kind of non-financial benefits that they try to make sound financial. So that way this can sound like a slam dunk from a return on investment perspective and give you some kind of ammo to defend the fact that you're joining the club. Can't fall into that trap. You have to look at this from knowing that there may be benefits there, and there undoubtedly are going to be non-financial benefits that come from this, from an experience side, from meeting people side of things, the networking aspect. It's likely going to be great. The questions that come up, though, is you can't look at that and say it's going to have a high return on investment. So I'm going to put this $50,000 in and I'm going to earn it all back on networking. Maybe that's the case, and that would be fantastic, but that is not what I hang on to as the reason for joining. So then we look at the types of clubs that are out there. Very careful about that. There's a lot of different clubs that exist. As you probably know, as you're going through this, I would look at a lot of different ones. They all have very different vibes associated with them. And this is not uncommon from whether it's a social club where you are in New York, or you look at country clubs or golf clubs, anything like this, where you have to start looking at not just, oh, we should join this club, but is that a club that we're actually going to enjoy being at? Because at the end of the day, for you to get the value out of these organizations, you have to enjoy going there. It has to be somewhere where it's not a hassle to go to. It's somewhere you enjoy. It has the right atmosphere that you're looking for. It has the right people that you're looking for. It has all of the things so that you're checking all the boxes to say, there is nothing else I want to do on a Saturday or after work one day than to go to this club. So testing it out as much as possible is going to be great. A lot of opportunities for members to bring guests. So you'd have that. Really take that seriously of digging into what it's like to go there multiple times, different events, and see if it fits everything. And that doesn't stop before you go through the initiation. After you go through the initiation, you pay a fee. And this is harder, but set a review period. Say, we're going to commit to join for a couple years. And if it's not delivering the value or the enjoyment that we're looking for to justify the cost, then we're going to cut it. Because what they're hoping you'll do, and inevitably what will happen in 2 years is, even if you're not enjoying it, you say this is a bad choice, one of you is going to say, but we already paid $50,000 to join this. And then it's going to be looked at as, well, you're right. So maybe this year we'll go in and we're really going to put the time into go to more of the events and everything. It's never going to work. You're just going to constantly play this game of throwing it in. And then by year 5, you're looking back saying, it's not the $50,000, but we've been paying $18,000 a year for the past 5 years. So we paid $90,000 into it. So why would we stop now? That's what they're hoping for. It's like a amplified version of a gym membership that you're dealing with, which means you just got to make sure that that's set up ahead of time. So this is it on the review period. We're willing to lose the 50 grand on the initiation fee, knowing that that is a sunk cost. So you spent it, it's gone. Now the only decision you're making is it worth every year that $18,000 fee? And if it's not, you bail. At the end of the day, this kind of goes back to what I was just saying, is this is not an investment. As much as some would like it to be an investment or think about it as ROI or anything like that, it is not an investment decision. It's a consumption decision. You are spending this for enjoyment. You're spending it for the networking, the environment, and the others, which is completely fine. But it is not a ROI decision. And it's just a consumption decision of, is this how you would like to spend $18,000 of your budget a year and $50,000 now? And if it fits in your budget and you've answered yes to a lot of the things we're talking about, then go for it and enjoy it and be a member of the club and enjoy all the things that they have to offer. And now we can jump into our final question.
We've hit Coast Fi and are both in our early 40s. We're thinking about shifting to part-time work so we can spend more time traveling while our kids are still young. How do we evaluate whether that's a smart move financially or if it's too soon to slow down?
So a big portion of this whole idea of Coast financial independence, Coast Fi type scenario, is that you've saved up aggressively through your 20s and 30s. Now you're in your 40s and you are right there, right? You've done everything that every finance professor tells students, every financial advisor says is save early, save often, and it'll pay off at the end. You've hit that point. So now you can cut back. The issues that you're likely going to run into that's going to make your situation a lot different than the traditional financial plan that's out there is, one is the way you model this. You're going to have to be extra conservative in how you model out your plan to make sure that this still holds up over the long term. So a couple ways to do that, even on the back of the envelope math, I would use more conservative return assumptions. So take whatever return assumptions you have, drop them by 1% or 2%, just to make it where you're really stress testing that model in a bigger way. The other thing to do, and this when I hear regularly, somebody says, well, I can use the 4% rule. I had 4%, I'm just going to multiply whatever I have times 4%, make up the difference in part-time income. That sounds fine, but you have to remember the 4% rule. And for those who are unfamiliar, basically this idea came out of the 90s in some academic literature showing that if you take whatever amount you have in your account, multiply by 4%, you can pull that amount out of your account with a really high probability of success. There's nothing wrong with it, but it's very much a kind of one size fits all type model. And unfortunately, it doesn't do a good job of taking into account issues like taxes or time, especially when you're dealing with really long retirements. It was based on, I think, a 65 retirement, a 60-40 portfolio, and 4% found it to be a good number. That's been tested over time. Morningstar famous hit something a couple of years ago. They came over like 3.5%, and then it got pushed back up. So you're somewhere around that 3.5%, 4%. What I would say in your case is I would see whether or not it still holds up at a lower withdrawal rate. Push that down to closer to 3% or a 2.8, 2.9% withdrawal rate. Combine that with some low returns, that's going to give you a better idea. I would hesitate or at least be very careful with how you look at things like Monte Carlo simulations. When you start running updated projections, you're now talking about a 50-year retirement. So there is so much dispersion in where your possible outcomes can go that Monte Carlos are going to be naturally conservative. They're going to give you a really low success rate, even though it's probably still going to be okay. And the reason for that is Monte Carlos are bound by zero in these types of models. So you start off today, your account goes up. So you have all these different possible scenarios, and you have one where you have $200 million, $500 million in an account, but then you have another one that goes to zero in 5 years. The zero is going to count, but there's no extra bonus points for the $500 million scenario. So we have to take that into account and know that your Monte Carlo simulations will also be conservative on that. The big factor that I would be concerned with is just expenses going forward. Not only expenses that you can control to make sure that, all right, you're spending time with your kids. So are those expenses going to change? Do you feel that the lifestyle you're living now and the budget that you have is still going to be the case 5-10 years down the road? Is this accounting for college type expenses? What does this account for post-college? So I would really think about that in a big way. Travel tends to be a really big one. As you're mentioning, spending more time with kids, doing some travel. Travel budgets vary widely, and you're going to likely have big hits to a travel budget early on in this experience. So making sure that you had the ability to work part-time with that level of flexibility is going to be huge. I've talked to people in the past who get to this type of scenario that you're talking about, say, well, we're going to have time for their kids when they go to part-time, and we're going to do all this traveling, but their part-time job is not going to enable them to have the flexibility they wanted to be able to do all the traveling that they wanted to do. So that's a big one on that. The other two are a little bit further out of your control. Now you're talking about healthcare and taxes. So this is harder to stress test, especially for 50 years, like we're saying, of how you handle this. So be conservative. Go in there and start looking at what your healthcare costs are going to be, depending on what your income is. Right now, everyone has different beliefs on what their financial independence number would be. Sometimes it's as low as $20,000, $30,000 a year. Sometimes that's $500,000 to $1 million a year on what you're looking for. So find out what that looks like, and then look at the implications of healthcare and taxes. What I mean by that is, if tax rates were to increase 10% on you, does this plan still work, or does it not work? There's a pretty good shot over the next 50 years that taxes will probably go up and down. So we want to make sure that's accounted for in such a long-term plan. Healthcare is the same way. You're in your 40s, healthcare before 65 is super expensive. So unless you're getting some ACA credits and really being strategic about income choices, if that's an option, that's going to be a huge increase in your budget from that coverage, because you're not going to have employer coverage. So we want to be careful on that one. And the other thing that I would add in, just as a final piece to this, is be really careful about dropping out of a career in your 40s. And the reason for that is it's going to be much harder for you to jump in. Let's say, and I don't know how old your kids are, but let's say you've got another 10 years or so with them before they're in college and everything else. So if you try to jump back into your job at 50, that's going to be a lot harder. You're going to miss out on a decade of institutional knowledge. You're going to be closer to retirement. You have all these things that are working against you in that scenario. It's not an easy win for you to say, I'm going to jump out at 40 and I'm just going to hop back in once the kids are older at 50. That's going to be a really hard thing to do. So really try to make sure, and I'm glad you're already considering the part-time work, but trying to make sure that that resume doesn't show that big of a gap in it. Not only from a job seeking perspective, but just from a skill perspective of keeping things up to date and you staying active in the industry. So try some consulting, right? Try taking a sabbatical first before committing to fully part-time status, before cutting back. But I would still keep yourself active in whatever you're doing now throughout that transition, which sounds like you are before cutting everything off completely. And now for a rotating segment, Money in the Headlines, where we look at recent articles shaping the conversation around wealth and planning. This week, we're highlighting a piece by a behavioral economist in the Wall Street Journal titled "Why So Many People Get Financial Advice That Is Wrong for Them." This is something that really hits home for me and for us, a scholar, and the fact that what we found out really early is that when you start giving financial advice, especially as wealth increases, the choices that need to be made start to vary significantly. And what I mean by that is there's a lot of advice out there for someone trying to figure out how much to put in a 401k, or can they retire, can they not retire, and when should they take Social Security. A lot of good stuff out there for that. What that doesn't take into account, though, is all of the other stuff that's around it and all these other things that are not financially focused at all. What I mean by that is when you start getting out of that world, when you start having excess money or discretionary cash, or you start thinking about estate concerns, then not only are you thinking about your own personal behaviors, but also the behaviors of your family and everyone else. And the number of conversations that I had that we start looking at two clients that should have similar financial plans from a cookie cutter perspective or from a textbook perspective end up going in wildly different directions based on things like their tolerance for risk, based on goals, based on what they feel their kids can handle or can't handle from an estate perspective, what they value, what types of things they enjoy. I mean, I'll talk to somebody one day who says, I want to have a $200,000, $300,000 travel budget early retirement. And the next day I have somebody who says, I would hate to travel because I've traveled my entire career. That has nothing to do with the investments of their accounts, but everything to do with really getting to know the specific needs of an individual for financial advice. And this is exactly what comes up, and especially on the behavioral finance side of things. Take a well-documented example of this is looking at something around where you generated wealth from. Where you generated wealth tends to have a large impact on the types of decisions that you make. In other words, typically inherited wealth, people tend to be a little bit more risk averse with, because the thought process there is that this was not generated from zero. So the odds of it occurring again is frankly very low, right? On the other side, when you look at someone who's generated wealth, typically through entrepreneurship, risk tolerance is extremely high. And both of those have their issues. The inherited wealth component, you have this concern of what if it goes down? What if the market drops? I can't just receive this money again. I can't create another $1 million if the market drops $1 million in the account. So that's a problem, because we have to look at that and say the advice that that person needs to be structured differently around risk tolerance, risk aversion, really understanding how the markets work and what the limits of standard deviations are, volatility. On the other end, you have, say, an entrepreneur who creates all the money in there and says, it's all right if I lose couple $1 million, I can always go create it again. You have this overconfidence bias that ends up coming in. So even though they could have the exact same portfolio, they're in completely different worlds when it comes to how they invest, how often they invest, how they spend money, how they think about money. And this is a great article to pull all that together, that it's not only the financial advice from a textbook perspective, it's how that financial advice gets applied and what your thoughts are and your relationship with money. And then when you start talking about the estate side, what your family's relationship is to money. So that way you can start determining what's the best way to structure, whether it's gifts or legacy goals or different values that you're trying to instill in how they learn those things. Thanks for listening this week, and we'll see you next time. Hey, this is Stephan. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, share with us at scholarfinancialadvising.com/podcast. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.